Here is what the market is not telling you. Bitcoin is trading at $78,550 right now. It has been grinding higher for 4 straight weeks. Spot ETFs just absorbed $629 million in a single session. And yet, on-chain spot demand has been negative for the entire month of April. I am Eric from Alpha Market Meridian. Thank you for watching another video about Bitcoin. Let me say that again. The price is near multi-month highs, but the very buyers who are supposed to be accumulating are not accumulating. The entire rally has been built on futures leverage. This is the exact same structure we saw in January 2022, right before Bitcoin lost 70% of its value over the following 6 months. Now, I am not telling you a crash is certain today. What I am telling you is that the market has placed a tripwire at 2 very specific price levels. Break above one, and the shorts get liquidated toward 86,000. Break below the other, and you could see a cascade towards 72,000. I will give you the exact numbers and 3 strategies you can execute right after this analysis if you want those trade-ready setups with exact entries, stop losses, and profit targets. Stay with me. I promise you will have everything actionable before this video ends. Here is the call. Bitcoin is in a high volatility regime with a defined upper boundary. The trend on the daily time frame is an upward correction, not a structural bull market. On the 60-minute chart, price is compressing into a narrowing range between 78,100 support and 79,540 resistance. A breakout beyond either side will dictate the next $500 to $1,500 of movement within hours. DMY base case. BTC grinds sideways for another 48 hours, then tests 79,540. If that level fails, the bull trap narrative confirms. If it breaks clean with volume, we accelerate. The line in the sand is 79,540. Above it, bulls have control. Below it, and with a confirmed loss of 77,115, bears seize the initiative. All right. Pull up your 60-minute chart. I want you to look at the moving average structure. Focus on the MA20, MA50, and MA200-AS you can see on the chart right now. The MA20 is sitting at 78,612. The MA50 is at 78,445. The MA100 is at 77,482. The MA200 is at 77,426. Price is trading above all 4 of these moving averages. That is the textbook definition of a near-term bullish structure. Short-term momentum is stacked above medium-term, and medium-term above long-term. This is what traders call moving average alignment, and right now, it is still intact, but I want you to notice something crucial. The distance between the MA20 and MA100 is less than $1,200. That is extremely tight for Bitcoin. When moving averages compress this close together, they act like a coiled spring. The compression itself does not tell you which direction the spring will release. It only tells you that the release, when it comes, will be violent. Now shift your attention to the MACD on the 60-minute. The signal line and the MACD line are both positive, but the histogram has been flattening for the last 6 candles. This is not a bearish divergence yet, but it is a loss of momentum. The print you are seeing on screen is 111 on the MACD, with an RSI of 48.8, dead neutral. Neither overbought nor oversold. The market is in equilibrium, and equilibrium in a leveraged asset means both sides are positioning for the next dislocation. Let me give you the exact levels. On the 1-hour chart, immediate support is 78,100, followed by 77,115. The 77,115 level is critical. That is the point where the alternative bullish Elliott wave scenario becomes invalid, according to several analysts tracking the 3-wave structure from the April low. If BTC loses 77,115 on a closing basis, the downside roadmap opens to 72,936, then 71,345, and potentially 69,785 on the upside. Bitcoin is currently testing the 79,537 resistance zone. This level has been tagged twice in the last week and has rejected price both times. A confirmed 60-minute close above that level opens the door to 80,000, the psychological magnet, and then 86,000, which is where the next major trendline resistance sits. Michael van der Popp, who called the April recovery early, is specifically targeting 86,000 to 88,000 as the first key resistance zone once 79,000 breaks. Now zoom out to the daily chart. What you see there is that Bitcoin has been moving inside a sideways channel between 74,885 and 79,525 since mid-April. That is a $5,000 range maintained for over 2 weeks. Range-bound markets are consolidation markets. And consolidation markets resolve into trends. The job of a technical trader is not to predict which way they break. It is to identify the trigger points and have a plan for both outcomes. Point one more technical detail. The ADX is printing at 51 on the 14-period reading. That is a very high ADX. ADX measures trend strength, not direction. A reading above 50 says the current trend has significant power behind it. But here is the nuance. When ADX is high and price is moving sideways, it often means a directional expansion is imminent. The market is storing energy. The ADX is telling you the next move, whichever direction it goes, will not be subtle. Now let us move to the fundamental drivers, because the technical picture only tells you where the tripwires are. The fundamentals tell you who is planting them and why. Point 3 major narratives are colliding right now. First, the ETF flow story. May 1st, United States spot Bitcoin ETFs absorbed $629.8 million in net inflows. BlackRock alone contributed $284.4 million. Fidelity added another $213.4 million. This is one of the largest single-day inflow figures for all of 2026, and it follows a month where Bitcoin ETFs collectively added $2.44 billion in April, the strongest month of ETF accumulation since the start of the year. Let me be absolutely clear about what this represents. BlackRock now holds more than 810,000 Bitcoin, managing over $50 billion in Bitcoin-related assets. The money is coming from pension funds, wealth advisors, and long-horizon allocators who are treating Bitcoin as a macro hedge against inflation and currency debasement. This is institutional conviction, not retail speculation. It is structural. Second, the regulatory catalyst. Over the weekend, the United States Senate passed a stablecoin compromise bill. This removed a key legislative obstacle to broader crypto market structure reform. Regulatory clarity is not just a sentiment boost. It opens the door for the next tier of institutional capital that has been sitting on the sidelines waiting for legal frameworks to solidify. Bitcoin immediately rallied back above 78,000 on the news. But here is the third narrative, and it is the one that should concern you. CryptoQuant has published data showing that Bitcoin's April rally, a 20% gain from 66,000 to 79,000, was driven entirely by perpetual futures demand. Spot demand remained negative throughout the entire move. On-chain apparent demand hit minus 87,600 BTC. What does that mean in plain English? It means that while the price was rising, actual buyers who take coins off exchanges and hold them were not participating. The entire rally was speculators opening leveraged long positions. Spot demand reflects coins being bought and held. Futures demand represents short-term bets. When price rises on futures demand while spot demand stays negative, you have a rally built on leverage, not accumulation. CryptoQuant's research director Julio Moreno has described this dynamic as one of the clearest on-chain warning signs in Bitcoin analysis. The structure is identical to what was observed at the beginning of the 2022 bear market, when Bitcoin subsequently lost 70% of its value over many months. I am not saying history repeats identically, but I am saying the structure rhymes. And when the structure rhymes, the prudent trader does not ignore it to to make this even more tangible. The Bull Score Index, which combines liquidity, demand, activity, and sentiment metrics, dropped from 50 to 40 during April. A reading of 40 is bearish territory. Meanwhile, the Fear and Greed Index has recovered from 39 to 47, putting us in neutral territory. This is not a market driven by organic conviction. It is a market driven by transient leverage and institutional headline chasing. Now let me connect this to the broader risk asset picture, because Bitcoin does not trade in isolation. The S&P 500 just closed at an all-time high on Friday, buoyed by rate cut optimism and easing geopolitical fears. Bitcoin has been moving in near lockstep with the Nasdaq 100 for most of 2026. If equities continue pushing higher, Bitcoin spot demand could eventually catch up to the futures premium. But if equities stall or reverse, perhaps on a hawkish Fed surprise, the leverage under Bitcoin becomes a liability, not an asset. Here is my 1 to 2 week directional framework. If spot demand flips positive, meaning the apparent demand metric goes from negative to positive, and Bitcoin holds above 78,100, the path to 86,000 opens. This would require sustained ETF inflows plus an absence of major risk-off shocks. The alternative scenario, if spot demand stays negative and BTC loses 77,115, we test 72,000 within the week. The event risk that would accelerate this downside includes a hotter-than-expected US CPI print, renewed Middle East escalation, or a sudden unwinding of the futures premium. All right, you now have the technical map and the fundamental drivers. Let us move into the most important section. 3 precise trading strategies adapted to 3 different risk profiles. Each strategy has exact entry conditions, stop-loss logic, target levels, and a clear invalidation point. If you are new to the channel, this is where you take notes, but before I give you these strategies, let me ask you something. What price do you think is the true line in the sand for Bitcoin this week? Drop your answer in the comments now, a single number. I read through these every day, and the best call gets pinned. Type it in while I walk through the setups. Strategy 1. Conservative, range accumulation with confirmation. This is the high probability, lower risk setup. The logic is simple. Bitcoin has been range-bound between 78,100 and 79,540 for multiple sessions. Instead of trying to predict the breakout, you wait for the range to prove itself first. Entry condition 1. Wait for Bitcoin to pull back and test the 78,100 to 78,300 support zone. Do not enter immediately on the first touch. Wait for a bullish rejection candle, ideally a 60-minute close with a long lower wick and a body that closes above the MA20. Entry condition 2. RSI on the 60-minute must be above 45 at the time of entry. This confirms that momentum is turning up from a neutral zone rather than diving into oversold weakness. If both conditions are satisfied, enter a long position. Stop loss. Place it at 77,650. That is slightly below the 77,115 invalidation level, which gives you a buffer against wick hunting. The logic is that a close below 77,115 invalidates the short-term uptrend and signals that the downside roadmap towards 72,000 has activated. You do not want to be long if that happens. Target 1, 79,300. That is the upper edge of the range, just before the 79,540 resistance. When price reaches target 1, move your stop loss to break even and take 50% of the position off. Target 2, 80,000. This is the psychological magnet that has been drawing price higher all week. If BTC clears 79,540, 80,000 becomes a high probability target. This strategy offers a reward-to-risk ratio of approximately 2.3 to 1 for target 1 and 3.5 to 1 for target 2. The invalidation condition is a 60-minute close below 77,115. If that happens, exit immediately, regardless of whether your stop loss has been hit. The probability of this setup triggering today is moderate. The range is held for 8 consecutive 60-minute candles as of this recording. The compression is real. Strategy 2. Standard. Breakout momentum chase. This is for traders who want to capture the explosive move when Bitcoin finally breaks out. The risk here is higher than the conservative strategy, but the reward to risk is significantly better if you get the direction right. Entry condition. Wait for a 60-minute candle to close above 79,540. Not a wick. A body close. Volume on that candle must be at least 40% above the 20-period average volume. This is what separates a genuine breakout from a liquidity grab. If volume is not confirming, you sit on your hands. Once that candle closes, enter long on the next 60-minute open. Do not chase the wick. Stop loss. Place it at 79,100. Tight. The logic is that if price breaks above resistance and then immediately falls back inside the range by more than $400, the breakout is false. You want to be out quickly when that happens. Target 1, 80,000. Same psychological magnet. Target 2, 82,189, which is the classic pivot R2 resistance. Target 3, 86,000. This is the major trendline resistance that Van der Pop flagged. If momentum carries beyond 80,000 with institutional volume behind it, 86,000 becomes the next structural target. Move your stop loss to break even after target 1 is hit. Trail it to target 2 after that. This strategy offers a reward to risk ratio of approximately 6-to-1 if target 3 is reached. The failure condition is simple. A 60-minute close back below 79,100. If that happens, the breakout has failed and you exit. Strategy 3. Aggressive. Short the bearish divergence. This is the countertrend strategy. It is explicitly high risk and only suitable for experienced traders who understand that fading a trend in a high ADX environment is dangerous. I am including it because the on-chain data supports caution, and if the bull trap materializes, the move down will be fast and profitable. Entry condition. Bitcoin must first rally above 79,200 and then reverse sharply, closing a 60-minute candle below 78,800. This pattern, a push above range resistance followed by an immediate rejection and close back inside the range, is the classic signature of a bull trap. Additional confirmation. On that rejection candle, MACD must print a lower high relative to the prior swing high. That divergence signals that momentum is fading at exactly the moment price is trying to break out. If both conditions are met, enter a short position. Stop loss, 79,600. This is just above the 79,540 resistance. If price reclaims the breakout level after your entry, the trap has failed and the breakout is real. Get out. Target 1, 78,100. The range support. Target 2, 77,115. This is where the bullish scenario invalidates. Target 3, 72,936, the first major Fibonacci extension from the downside roadmap we discussed earlier. The reward to risk ratio for this strategy is asymmetric. If target 1 is hit, it is roughly 1.8-to-1. If target 3 is reached, it expands to over 6-to-1. But let me repeat the warning. This is a counter-trend short against an ETF-driven bid. The probability of success is lower than the long strategies. Do not size this aggressively. I am showing you this because professional traders have plans for both directions, not because I am telling you to bet against the trend. Before we wrap up, let me speak directly to risk management. This is not filler content. This is the difference between a trader who survives 5 years and one who blows up in 5 weeks. Rule 1. Never risk more than 1-2% of your total trading capital on any single trade. If your account is $10,000, your maximum loss per trade is $200. Period. Set your position size accordingly based on your stop-loss distance. Rule 2. If there is a major macroeconomic event on the calendar, think CPI, FONC minutes, or non-farm payrolls, do not hold leveraged positions through the event. The slippage can exceed your stop-loss before you have time to react. Rule 3. A stop-loss is not a suggestion. It is a contractual obligation you make to your future self. The moment you move a stop-loss wider to avoid being stopped out, you have abandoned your risk framework. That is how small losers become account-destroying catastrophes. These 3 strategies I gave you each come with a defined invalidation point. Respect it. The market does not care about your conviction. It only rewards discipline. Let me bring this together. Bitcoin today sits at a precipice. The 60-minute chart shows a compression range with an ADX above 50, a coiled spring. The moving average alignment on the daily chart still favors bulls, but the on-chain demand structure mirrors the early 2022 bear market setup. ETFs are buying aggressively. Spot buyers are not. That is the contradiction you need to trade around. The two levels that define everything today are 79,540 on the upside and 77,115 on the downside. A daily close above the former opens 86,000. A daily close below the latter opens 72,000. Everything in between is noise. Tomorrow, keep your attention on two things. First, any update to the US CPI or labor market data that could shift rate expectations. Second, the ETF flow data. If we see a second consecutive day of 600 million plus inflows, spot demand may finally start turning positive. That would be the most bullish signal we have seen in weeks. Now, I want to hear from you. Are you buying this breakout or fading it? Drop your directional bias in the comments and give me your exact line in the sand price. One number. I will pin the most accurate call tomorrow. Hit like if this analysis gave you something actionable. Subscribe and ring the bell. We cover 8 assets every single day from Forex to crypto, and the next video on gold could be the one that saves your portfolio from a positioning mistake. I will see you in the next one. Trade smart.